Good evening, all. Ira Epstein with your financial market wrap-up, and this wrap-up is for Thursday, the 3rd of August, 2023, getting on to 5:40 p.m. Central Time. Aren't you happy? I'm a little earlier. All right. I'm going to be doing a special report. I discovered today, I've been studying it for 3 days. What do I want to do? I'm going to do the seasonals in the stock indices and show you what goes on and what I think will go on from right now into the beginning or mid-October, looking for the year-end rally that I still expect will take place. What you're facing right now are earnings. I'll talk about those that came out in our Spider ETF video right after this one. What else you're fighting right now are rising interest rates, and they have soared over the past 8 to 10 days, carrying the markets dramatically higher. Some investors think that rates can get up as much as 5% in the 10-year. They're talking an awful lot about that. Bill Ackman has got involved with that. Warren Buffett just said he bought $20 billion over the past 2 Mondays, $10 billion each time, buying Treasuries, and he's going to buy another $10 billion on Monday, probably the 3 to 6 months in those. He's telegraphing what he's going to do. Why is he doing it? Because he can pick up 4 or 5% pretty easy for a short period of time. No risk in the market. Look where the market's at. But I don't know what duration he's doing in the rest. The argument against doing that is this. Short term, I get it. The moment you start doing this for years at a time, what takes place is the market will shift gears. High interest rates inevitably lead to lower rates. Lower rates inevitably lead to higher rates. So there's a cycle that goes like that. In between the cycle, what typically happens is high rates break the stock market. Well, this has been a market that's really not gone with that much, right? We've had a strong market all year and interest rates have been high. So what if the seasonals kick in and carry you higher at the end of the year? That's what I want to point out. And I'll do a special report. You'll see it. I'm going to do it on each one of the indices. Look for it. When we look at the S&P right now, you can see how the market is backed off for the week. At this point, even with the markets open tonight, you're down 1.75%. On the daily chart, you have broken down and you have a short-term downtrend at work. Lower highs, lower lows. I don't think you'd fight that. You're under the 18-day average, so the bias is down. A potential support zone is wherever the Bollinger Band is hit, 4503.5, with resistance at 4566, the 18-day average. If you sold there, you'd have to risk 50 points, just if you want the pattern to hold up over the 45, let's call it 67 level. That's a big risk. I'm not convinced I like that. And in addition, I think you've milked this market pretty hard because you're already in oversold territory. That doesn't mean you can't go down and hit that Bollinger Band tomorrow. What report do we get in the morning? We get the all-important jobs report. Is it as important this time around as it's been? No. Why? Oh, let me ask Ira. I can tell you why. Because you're going to have another report after this one before the Fed meets. So this is the first we're looking at. The market is looking for it to show a decline to 200,000 jobs with 3.6% unemployment. So, Ira, what happens if the number comes in 240, 250, 2.25? That will be considered a strong number. And what happens if the market gets that and it falls back, Ira, come the August number? Oh, well, let me tell you what I would think on that. That might mean in front of the Fed meeting, they're seeing it abate a little bit. It's wobbling. Obviously, if you see both numbers fall under 200,000, the Fed's going to like what it seems. Okay? Now, when I look at the NASDAQ, oversold, reaching for the lower Bollinger Band, this is not about an embedded reading being lost. This is just a market void of a trend. Higher high, lower low. In the Dow, you did lose the embedded reading. The goal was to get back to the 18-day average. Ring the bell. You absolutely did that. In the Russell 2000, you had lost the embedded reading. The goal was to get back to the 18-day average to fight a battle. You did that as well. Now, in the bond market, as bearish as this all is looking, would I ever tell a trader to go short under this? Never. Not going to happen. Why? Because only 5% of the time do you stay outside of the bands. That doesn't mean you can't move to the right of it very easily and keep falling. I'm not saying prices have to bottom. It's going to get back inside the band. Often when you try to get back in the band, you do it by a rally. Does it have to be much of one? It does not. So don't go by this fact that you're seeing it do that. Please, I've seen this. This market is telling you it's bearish. It is not showing you that it's changing its colors just yet. In the 5-year notes, you're very oversold. Both numbers are finally under the 20 level. They either are going to stay there and embed saying lower numbers, or they'll get oversold, we'll get a bounce, and probably get a move trying to get back to the 18-day average. Let me show you something important here. Notice how the 5-year, did you see that just go black on us again? Do you see that? The market is just right through here doing what? The market is, if you will, playing at this point in time, going sideways. And if I go back to the 30-year, it's not. It broke out. So what's going on is the back end of the market, the one that analyst upon analyst upon analyst said, we're not going to go back and challenge old highs, are wrong. This has been a rough market. This has been a market where traders thought that their earnings would come out terrible. They're good. This has been a market where people have been amazed that the naysayers drove the stock market up when people went down. A big surprise for 2023. And the next surprise that's hit people is the back end of yields going higher, and the curve yields going from 100 back to 70, and it's all because the back end is going higher at this point. As we go to the dollar index, you're back up to an area I'd be very cautious about. You're hitting the upper band. You're not over it. Between here and the 200-day average is massive resistance. You have both numbers finally get over the 80 level, but you have to do it several times to embed. So it's a very overbought condition going into the jobs report. In the euro, I was not looking for the Bollinger Band. I mentioned that yesterday. I said, all it really has to do is to the 100-day because you're already so oversold. It's there. Obviously, tomorrow the jobs number can be the mover to either put it down to the band or kick the market back up. We'll see when it comes out. In the British pound, I'm sure traders are scratching their head. Hey, here they go. They're raising rates again. How come it stopped at the Bollinger Band? Because that's what it does. That's what it's supposed to do. You don't have a tight sideways range. You've been coming down. This is the profit-taking area for a lot of the traders. They're saying, I earned my money. That went down. Now I'm going to take money off the table. Bitcoin is nothing. It's got a higher high, lower low, but, and this is so important, it lost its bearish embedded weight. Look at this. All right. Here is the market yesterday, August 2nd. Here is the market today, August 3rd. What's the reading? 26. The odds favor that before you get under this low, you're going to go back to that 18-day average, so pay attention. In Brent versus WTI oil, the difference is $4 a barrel at this point. You are still staying very strong, and an event happened here that we have to pay attention to. Again, let's step back a day and see what the market did. This is August 1st. The market's still embedded. This is yesterday. You lose the embedded reading. The only day you can get it back before you have to restart the whole process of embedding is the day after it's lost, which you ended up doing today. Put both numbers back over 80. And I don't know if they're following through tonight because you're not open. When we look at WTI, it did not lose the embedded reading, according to how I teach it, and it came back up today with a pretty good vengeance. So the bulls are still fully in control of this market. We talked yesterday about Rebop gas, where if it broke down, I am still in awe of the size of the break yesterday. I didn't expect it, and I lost, for my subscribers, I was wrong that trade. It happens, all right. But I was looking for the market to find support. If it went down to the 18-day average, it's there. I also think you've got your summer highs in place. Be careful here. This could be an important high in the market. In nat gas, I don't like being short beyond the Bollinger Band in an oversold market. I told you I thought we'd be sideways going nowhere. We've been right on that. Now, it's running about $250,000 a day for these LNG takers to sit in the water before they get unloaded. Interesting. A lot of pressure on these markets, but a lot of LNG movement going on. You're in a phase of the market where I'd be very surprised if pivot points don't come completely back into play. When you get markets that go vertical, they'll start going sideways afterwards. When they do, the pivot point comes in. You're looking for a center line. By the way, you probably have this on your charting software. Open it, look for pivot points. I doubt you use it the right way, but you might. The center line, you're going to have lines above it. I'm going to stop. I want to stop right here. Now let me get this going. And we're coming. That's the center line. I wanted to redo this. It's called the P line. Now you're going to get resistance lines above the market, support lines below the market. It is for entry and exit, but only intraday. Got that? It is not for position trading. So as the market's rallying up, you're looking at these areas and you're looking to see, am I peaking out in momentum? And you're looking at the market down. You use, it could be a 5-minute, a 10, a 15-minute chart. There are different ways to do it. I show you what I do in my course because the course is free to you. I want to show you how I teach different things. So in order to get the course and learn how to work with it with momentum, it's pretty simple. You go to our website at iraepstein.com in free offers. You heard that? Free offers. And you will get the course. It's video. Use your charting software. If you want ours, just let us know. We'll be happy to give you a free trial to it. My slow stochastics will be different than yours. And the reason is I changed the formula, not the numbers. Oh, am I going to use a 5 and a 3 and this and that, and 80s and 20s? Not what I'm doing at all. Whole different thing. You can move your cursor up to the top here. You can click. You'll see free offers. You can go here. You can call my staff, and we want to hear from you. I'm Ira. You have yourself a good day. I'll talk to you Friday.